For every deal that I source and bring to you, I do my own diligence. And for BuildEnergy Fund I, our family office allocation of Upstream Fund VII, I got to meet Jeff Mohajir, our GP. And although I've been invested with Jeff, I wanted an opportunity to meet him, get a feel for him in person, and also just ask him the tough questions that you do before you put your name on something and take it out. I knew that you also would want this opportunity to ask about strategy and his approach, especially in this market with oil and volatility. So I asked for this call where our investors got to ask him anything and have a Q&A session. I reached out to Aspen Funds to help orchestrate this, and they in fact got it scheduled for us, but on a day when I was on an airplane. So I wanted you to have this recording. Check out the Q&A with Ben Fraser and Jeff Mohajir.
We really wanted to kind of open this as a, ask me anything type of forum. And so we have a lot of people from, our other oil and gas investments currently committed for the fund that is currently open, Fund VII, as well as prospective interested folks in investing in oil and gas. And so we wanted to kind of open it up and just have a conversation that we thought would be beneficial for everybody to, talk about some of the market volatility that we're seeing, to just talk through, again, the strategy that we employ through our fund in finding what we believe to be, great risk-adjusted opportunities in the market. But as we always see, right, with volatility in the market, we see, some concern with tariffs, with the economy. Obviously, oil prices have slid a little bit. I think it's a good time to address some of the conversations. And so we're very excited to have Jeff Mohajir on. Jeff is the CEO of Mohajir Energy Advisors and our partner in Upstream Energy Fund VII. So very excited to have him on here. He's the resident expert, all things oil and gas, geology, the strategy that we're really employing. So Jeff, thanks for jumping on the line with us here.
Well, thanks for having me. It's always great to talk to the folks at Aspen, and you in particular, Ben. And I'm happy to be here to answer questions. Hopefully I'll be able to have a good, concise answer for the folks that are looking for answers to the questions.
Perfect. Well, let's just dive right in. I know we got a lot of questions to cover in just an hour here. So I think the first thing on everyone's mind is volatility and commodity prices. And Jeff, this is not your first rodeo. You've been through several cycles, right? You've seen this. So I think it'd be helpful for you to maybe give us a little bit of perspective on what you're seeing in the market right now. What do you think the market is concerned about? And then secondarily, how does that impact potentially, if at all, our strategy in going and acquiring assets in this type of a price environment?
Well, as it pertains to the energy industry, like any other market, it really doesn't like volatility or uncertainty. Obviously, as you can imagine, we are in an industry that produces a depleting resource. And so one of the things that we do to keep that resource in place is do drilling and development, which is what we participate in, quite a bit. So to be able to get comfortable in drilling a well, particularly if it's a horizontal well that might be, anywhere from, $10 to $20 million, and to see, volatility in, a short amount of time, change the price, the commodity prices, it really, it makes people, concerned about deploying that kind of capital. So what I think we're seeing right now is we're seeing, some rig count go down. Obviously, a lot of what's driving current drilling and development are oil prices. But I think one of the things, to be kind of on a high level here, one of the things we might see as rigs go down and oil production might go down a bit as we are forecasting into the next 2 or 3 quarters. We might see a little bit of an uptick in natural gas prices because as oil wells are going down. All the associated natural gas that is expected to be produced along with those, that'll be going down as well. So while oil's trading, it's up a little bit today, largely because of some of the tariff news, trading around $62 a barrel. Oil is well above $3 in kind of that 325 range. I'm sorry, natural gas is in that 325 range. And that's a pretty good thing, I think, for most people, most natural gas producers. As it pertains to us, obviously.
And before we get there, Jeff, just real quick, I think I'd love to a little more on the energy market, because I think this is really helpful for people to understand. So when you're saying oil rig count, explain that a little bit more, right? That's kind of a leading indicator of future development, right?
Correct.
And in future production. And the oil market, I mean, oil and gas, but they're always trying to find the equilibrium, right? Where the supply and demand, and there's, like you said, there's fear in the market, there's volatility in the market that can create a pullback of price because of future expectations of demand. But there's also the other side of the equation, which is the supply side. And that also reduces potentially supply, even in the short term, production that will then support, what the current demand is. So talk through just how those factors play out through these economic cycles. I think that's really helpful to kind of tease out the nuance there.
Yeah, I mean, we track, actually there's a service, Baker Hughes, which is one of the largest drilling service companies in North America, sort of tracks all of the drilling rigs that are producing. And what we really focus in on are all the drilling rigs that are working in the lower 48 states and the United States. And as prices go down, we see some operators where the economics of drilling that well might be somewhat thin, or there might be some real risk associated with it. We see some operators start laying rigs down. So obviously, like we've talked about before, sometimes the best cure for low oil prices are low oil prices, because once those rigs start getting laid down, you start seeing production go down and supply go down. So as production and supply go down,
price go back up.
Correct. Yes, and that's what and quite frankly, on a very high level, oil for the most part is traded largely on the perception of China's economy. I mean, it's traded on demand, obviously, and it's largely traded on China's economy, with one of the big assumptions being that whether it be through Saudi Arabia or South America or the United States, there's enough supply at the right price to marry supply and demand. As it pertains to natural gas, I would say that's much different, because natural gas is much more of a domestic commodity right now. And natural gas really is traded largely based on whether it be power usage or industrial usage. So,
yeah. So let's shift to strategy, right? So if we are in a lower price environment, what does that mean as we're trying to acquire new assets? And then also, what does that mean for the current portfolio that we have of assets and prior funds? And talk about that a little bit with the current pricing.
Well, I mean, for the new fund, it's great, because we're out there right now looking at deals, evaluating deals, and it just means that some of those deals that we're looking at and that we kind of like might get a little cheaper. So from that perspective, it's great. As it pertains to our current portfolio, obviously it's as prices go down, it's going to affect our cash flow. But one of the things to remember as we are deploying capital, one of the things that we really like is we like commodity diversification. So we like oil, we like natural gas, and we like what we call, rich natural gas, which produces a lot of natural gas liquids, propanes, butanes. So one of the things that's been kind of nice, at least for the existing portfolio, as oil's gone down, natural gas is actually up. So there's been a little bit of a natural hedge, a volumetric hedge, as you would say, on our existing portfolio. And we do have some hedges in place, some financial hedges in place as well. But again, with one of the things that we really wanted to, as we were talking to Aspen and Ben and the guys, thinking about commodity price volatility, we thought now was a good time to be raising the fund because of the volatility and because we think we can really continue to buy or get into areas or projects at what we could consider a market discount.
Yeah, I love it and totally agree. I think from my perspective, a lot of the volatility we see, not only in commodity prices, but the public markets in general, it's reacting to a lot of short-term news and what the potential short-term impact could be, right? And so we're seeing maybe the expectation of China's demand going down, U.S. economy maybe struggling a little bit with the tariff impact, so less oil demand. But it's not thinking super long-term, right? We've talked about many times in past webinars, there's a structural supply challenge that we have to continue to meet current demand and growing demand over the next 10 years. And the great thing about right now is that's not really being priced in, right? So if we can go and buy assets at a lower price of oil or natural gas, the way a lot of these are priced, I think we may talk about this in other webinars, but it's usually in some form of a discounted cash flow, right? So they're forecasting what the expected cash flow will be over a period of time, and they're building into that the or what really the current pricing is in the market and using some futures curves, et cetera. But when those numbers are lower, the net present value is also lower, which means you could potentially buy at a better value, a better basis. And as prices go back up, that benefit largely can be accretive to the investors of that asset, right? So it's in some ways, I view it as kind of a short-term dislocation of price relative to what we think is the long-term structural supply challenges. And that's really, I think, where I get pretty excited right now because we have a pretty good sense of what the long-term picture looks like. In the short term, it actually might be beneficial to go shopping right now because it's a little bit of a less competitive environment, maybe a little bit lower pricing environment. We can get better value. And maybe comment on that and correct me if I'm wrong if you see it differently, but it seems to be, it could actually be a great recipe for acquiring right now.
Oh, for sure. Right now is a great time. I do think some of these low prices for folks that were on the fence thinking about selling, I think this volatility that's right now in the marketplace, particularly as it pertains to oil, might put them over the edge. And we're talking to a lot of folks about that. So it just gives us the ability to, like we've talked about, buy something that we perceive to be below market at a high net present value discount. And, one way to think about it is, if you're buying a cash flow stream discounted at 20% at a commodity price, for oil at $60 a barrel, well, part of the game for us would be to take that same cash flow stream, continue to add to it through development, and then sell it, 10 years from now at, $75 a barrel, and so that's where we really create a disproportionate return, and we create a bunch of value in the project creation.
Yeah, love that. Talk a little bit about kind of break-even price of oil. Where do you normally see that at when you're thinking about existing portfolio and future acquisitions?
Break-even, obviously is kind of an art form or an art term, and it really depends on, geology and engineering and production and, expenses and all kinds of things. In our current portfolio, I will tell you this, our break-even is $45 oil and $1.50 natural gas. So that is sort of our break even.
So
the only time I've ever seen it get to that point is during COVID.
But let's play that out a little bit, because I think it's helpful to think through, because a lot of people think, oh man, if oil goes to $45 a barrel, we're toast. But the reality is, like you said earlier, low commodity prices solve, the best cure for low prices is low prices, meaning
Correct.
The market sorts itself out, finds its equilibrium, and prices generally go back. We generally go back to, the 60s and 70s over, a long-term average. And so
if you get a quick drop, you typically, and you can see this, and if you look at it, we do this, and we should send it to you guys. If you're tracking oil and natural gas prices from 2005 all the way to current, and you see these wild drops, the bounce back up is very quick. It is very quick. So even in COVID, one day, April 11, 2020, traded at negative $37 a barrel. I think the next day it was back up to $35 a barrel. I mean, that's a pretty big bounce.
A big bounce.
So yeah.
So talk through that. What do you do in that scenario? Obviously, if you're below break even, you're going to have a kind of cash flow drag, but the expectation is not going to be for a very long period of time. If it is a long period of time, do you shut in well? Like what's the thought process from an operator standpoint, or do you hold it out because you're going to recover it at some point?
Yeah, I mean, we wouldn't shut in wells. We typically wouldn't, because you want that cash flow. You wouldn't want everything to just stop. And again, from from what you just said, what I'm talking about, we don't think it would stay there very long, the low prices. So you wouldn't shut wells in necessarily. And I'm giving you prices per barrel or per MCF that are within our portfolio. I'm sure some of our best producing properties could probably go down to $25 a barrel, or $1 per MCF on natural gas. So I'm kind of giving you the good and the bad together. So that's kind of an average.
Right.
One of the things we like about taking the non-operated working interest is it's not really us who's going to shut in the well. It's going to be the operator. And the operators like to have that cash flow. Now, what they will do is they will lower operating expenses in the way that they will no longer charge overhead if the well is making negative cash flow. So that's one of the things that we do, track very quick, very tediously, and want to make sure that when we look at each well's P&L, we want to make sure that it's, it's got field level income.
Right. And I think the other thing we got to layer into this conversation, because we're kind of playing out scenarios that I think are a little bit extreme, right? But it's helpful to think through what are the outcomes, or just kind of the decision tree there. But the other factor you got to layer in here with our strategy is hedging, right? So even if oil prices go to $45 a barrel, that doesn't mean we're actually at fund break even, right? Because we are likely in the money on a large portion of, or significant portion of our production hedged at higher oil prices. So it really have to drop even further theoretically before the fund's cash flow is actually below zero.
That's correct. And we typically hedge in a rolling 18-month cycle.
Yep.
So, right now in the current portfolio, we might be a little under hedged. We're at about 25% of our volumes are hedged, but they're at good prices and we feel really comfortable about it. And the hedges that we have in place volumetrically will allow us to continue to pay operating expenses and service debt.
Right. And to kind of flip this a little bit, a lot of times, even in the current portfolio, the current fund, where we are doing active drilling, we are still making participating in new wells, even small acquisitions, it can actually create a great time to go and buy into that market, right? To capture that upswing. But talk a little bit about, I feel like we've talked about this before, but buying the PDP, a lot of times your kind of structural costs or break even in that can actually be lower than going to do new drilling. Is that accurate?
For sure.
Yeah.
So you're already buying, I mean, obviously all the drilling and completion costs on a producing well is all sunk.
Yep.
So we're not really having to pay for that. And we're paying for, some discounted amount of forecasted cash flow. Typically, an engineer is going to forecast the production, and then we're going to say, this is what we think the value of this production is, based on this commodity price scenario. So it's, depending on so the break even on that is going to be much lower than the break even on maybe a drilling well or a drilling project, where, for the most part, we're always going to want to, on an unrisked basis, we're always going to want to participate in drilling that is, in a 40 to 50% IRR return, unrisked. And then we start that, and then we start to risk it. So we'll risk it for operating expenses. We'll risk it for, drilling costs. I mean, the worst thing would be if the operator that we're participating with, were to really blow out the budget for drilling the well. And so we'll do some risking there. We'll risk it for, sometimes we will risk it for regulatory, whether or not, there's the right regulatory environment to be able to get the well connected to a pipeline or for the well to be sold. And obviously the biggie is, risking it for prices. So we test it, and if once we beat it up and it will get that well or that drilling location will get somewhere between a 15 and 20% risk rate of return, we will consider participating.
Got it. Perfect. We had a question come in on what are the prices for our hedges right now. I think I just pulled up the latest data. So correct me if I'm wrong here. We have, obviously, where they're rolling hedges, right? So there's, there's kind of a blended approach here. And we do generally costless callers, right? So
we have some puts in place too. You might see, do you have that pulled up?
I do actually. Yeah, I do. And let me,
we have some puts in place and we have some costless collars in place. And generally it looks pretty good, I think.
Yeah. On gas in particular, our puts, which is really our kind of floor, anywhere between 250 and 495. So it's on a rolling basis. With our calls, which is the kind of ceiling of the collar, anywhere from 415 to 920. So we got some real nice bands there. In oil, our floor is between 60 and 64. And our ceilings are between 75 and 79. So those are where we're kind of trading.
Yeah, I feel really good about those costless collars, and there probably were a couple of days last week that the oil was trading below $60. So, but we've got some pretty good protection in place.
Yep. And so those are on a rolling 18-month time frame. So again, part of it is we want to react to the market and provide the insights, but it's also, you got to keep the longer term perspective in place here, right? This is really important, and why we do the hedging. This is a great time to talk and show why it's valuable to do this, because it really smooths out a lot of this volatility. Now, you also give up a little bit of the upside, on the flip side of it, but that's a trade-off that's, we think, worth making. And again, I think that the strategy of going and buying existing production with good in place cash flow, you hedge a good portion of that cash flow to mitigate some of the volatility, and then go and leverage that to go and participate in, good projects where you can get these, higher returns through the drilling. It really works, throughout a lot of the volatility, right? Because you can adjust the strategy based on what the market's doing, and there's always a strategy that's working. You just got to be able to pivot, right, and have the cash flow in place. And so I think
that's true. And I would say to just add to that, I mean, the two things that are our big drivers really are, obviously we're very motivated by return, and we're very motivated by distributions. So when we are looking at trying to acquire a project or a set of assets, that's one of the reasons why we really liked there to be a large producing base in the property or the asset in the portfolio, so that we can bounce off, use that as a platform to get into some additional drilling. So we don't have to rely solely on the drilling to get distributions out to our members.
Yep. This is a question. So I think the underwriting price in the pro forma was 71.25. We're at 62.80. The bear case was 57. How is the fund restrategizing to handle this? I'm assuming this is for Fund VI. But again, we've kind of already addressed a lot of this. So
this would be for Fund VII, I'm assuming, and what percentage of the acquisitions have already happened in the fund. We haven't made an acquisition yet, but what this would mean is, if I would think what it would mean is that our acquisitions would be, if you were looking at that pro forma, we would get a better price. So we would be paying, we'd be paying less money for the same amount of reserves, basically.
Because the idea is when we're buying on a discounted cash flow basis, you're buying on a net present value based on the current prices. So that's I think that's the whole point, which is a great question. I'm glad you brought that up, is we can go and get the same production at potentially a 15-20% lower price because oil prices are impacting that net present value. And so that can be very accretive to the fund as prices potentially go back up.
Right. It's great. It's great on the acquisition side. There's no question. And on the flip side, in the existing portfolio, obviously, from a production perspective, we definitely want prices to be, as high as they can be. We don't want them too high because we are looking at participating in a lot of drilling.
Right.
And one of the things that we've seen is when prices do get over $80 a barrel, you get a lot of people drilling. And then one of the things that really happens right away is that the drilling costs go up because there just there's not enough service companies to service all of the rigs. So there's a happy equilibrium, as you've been talking about. And I always think about, the best band for making acquisitions, for participating in drilling, and for, producing properties is in that 65 to 75 band.
Yep. No, that makes a lot of sense. Great. Let's shift a little bit just to Trump policy impacts, right? And then we can shift more to some of the strategy stuff. But, it's funny because when we initially launched this fund a month or so ago, most of the concern related to Trump was, well, he's going to incentivize drilling. We're going to flood the market with no more supply. So it's going to oversupply the market and push prices down. But it's now kind of on the other side. It's like, oh man, all these tariffs are creating a lot of turbulence, might create a little more inflation, might create a weaker economy. So that's impacting oil prices. It's almost the other end of the spectrum. So I guess the question is, which is it, right?
Yeah. Well, I think right now you can see, again, I think this is holding true what I said earlier about, at least for oil being a global commodity.
Yeah.
So much of it is traded based on the perception of demand in China. Yep. And so with this heavy trade negotiations, particularly in China. You saw today, we saw, oil pop up a little over $1.50, just based on maybe there'd be a little bit of relief on some of the Chinese tariffs. So now what does that do? Some of these tariffs, particularly in Western Europe, for potential liquefied natural gas, it could mean that becomes more expensive as well for Western Europe. So there are a lot of liquefied natural gas plants that are in various stages of being of construction. So I think there's, they could make gas a little bit more expensive, but yeah, I think this is, in the meantime, I think this is all going to kind of play out the next few months, and we'll see it kind of back to normal. Yep.
It definitely feels like he's doing classic Trump strategy, which is, punch people in the mouth and shock them, and then, give a little relief and try and get what you want out of it, right? There's a question here from Katie. Here's a question. Trump says he wants oil at $50. Should we be expecting him to follow through on that, and for how long? It's an interesting question, because Trump can't really.
I was going to say, he can't make the price of oil. Now, what he has said, one of the things that, I think I mentioned this before, right now in our country, we produce around 13 million barrels of oil per day. He really wants to add an additional 3 million barrels of oil per day. But I think, most oil and gas companies, aren't going to do that, and they don't want to replace reserves at $50 a barrel. So I don't see that happening anytime in the short term. And like I said before, most companies on a risk-adjusted basis, in most basins, not just Oklahoma, but in most basins, need somewhere between $65 and $75 a barrel to really implement a long-term drilling program.
Right. Let's talk a little bit about kind of exit strategy. I think just to remind people, kind of how we look at when would we sell assets of the fund that we acquire, right? So one of the unique things of this fund is we have established a longer potential hold period. But historically, the other funds and assets that you've owned, you haven't, held them for 10 years. So it's not to say that we wouldn't, because, hey, if you're producing amazing cash flow and it's, hard to go replace that at something else, why not hold it? But there's also the optionality that we have, the flexibility of being able to take advantage of maybe a frothy or a hot market to sell into, right? So right now I view it as a great buyer's market. Right? It's a great time to go buying. Like you said earlier, potentially sellers that were kind of holding on hope for higher oil prices, and we're going to sell out and have a lot more bidders. Maybe they're a little more willing just to be done with it, be done with the volatility. They'll sell maybe a little bit lower price. But as we saw just, not too long ago, a couple of years ago, we saw prices break $100 a barrel, and everybody wanted a piece of the action. Everyone wanted to come in. We're paying, crazy premiums to do this. And so that's a very, very real possibility at some point along the next 10 years, right, of the hold period here, that we're going to see a frothier market. So talk about, from your standpoint, strategy. How do we create value? We said we're return focused. So we have a few ways we can do that. One is buying good value, good cash flow, leveraging that into good drilling programs that we can get a very strong risk-adjusted rate of return that you're saying many times in excess of 25% on a risk-adjusted basis. And then we also have the benefit of market appreciation from, maybe selling into a frothier market. So we don't build in, a lot of that into the pro formas. We build in is today's prices with, a certain amount of drilling, and we don't really build in a lot of excess premium on the back end sale price or excess premium on the run up in potential prices. So talk about how you think about that from just how do we maximize value here as we think through the kind of full cycle fund?
Yeah, I think any investor, needs to be opportunistic, obviously, and you need to be able to take advantage of the market when the market turns in a certain way. So that's one. The way that we do our forecasts and the way that we look at our cash flow models, we like to look at them in 10-year cycles. And right now, because, we don't think it's a frothy market, we put a 10-year forecast in, assuming the market is going to be the same. So we're just using, we're using what the current strip is. We're not trying to do any kind of escalator. We're not trying to say, hey, we're buying things at $60 a barrel, and then in year 10, we're going to sell when oil is $100 a barrel. No, we're just using the strip. So on the day that we're doing the cash flow model, this is what the strip is telling us.
And the strip is the futures price at different
times. Yeah, over the next 10 years. And as you mentioned, we like to think that we'll be able to buy a proved producing production stream, that cash flow, for a good price. And again, as you mentioned, one of the things that's important to us is that there are really good drilling or development opportunities that come along with that, like we have in our current existing portfolio. So as we are, executing, what we're really doing is we're creating additional production and or reserves that are layered on top of those producing properties. And we're taking what the current market, what people are buying in the market today, 10 years from now, we're using those metrics to say, this is the exit.
Right.
So we're trying to be realistic. Now, most of our careers, we've sold in what we would consider to be frothy markets, but we recognize that we're trying to manage expectations in that current market conditions.
Yep. Another question here from Nicholas. What is the structure of your contractual sale to your buyers? I mean, what % of your sales are done spot versus evergreen? How much of the production is committed to fixed buyers versus amount that needs to be marketed every month?
Are you talking about, he's not talking about selling the property.
I thought about selling the assets. That's selling the production. Yeah. So a little different.
We have I would say it's probably, I don't know this for exact, but the last time I looked at it, in the existing portfolio, we've got 50%. So 50% of our oil and natural gas is sold on the daily spot price. And then probably 50% of it is based on some kind of index.
Yep.
So, and for the most part, it gets averaged, on a monthly basis. We have some, and then on the natural gas side, we've got some, obviously some processing, and we're selling the natural gas liquids. Just it's, kind of a monthly price that companies like Kinder Morgan would buy our natural gas liquids.
Yeah. Let's go back to exit strategy. I think this is important to kind of play out different scenarios. So, one thought is, well, what if, a few years from now, the prices are still really low or even lower? Do we have to be sellers? What would be the strategy? Would we hold on a little longer? Would we extend the hold period? I mean, it's hard to think over the next 10 years we wouldn't see some level of a potential frothy market, right? So what you're saying is that it's part of the reason why we have to have that flexibility in the hold period, is because we know at some point along the way there's going to be better times to sell and better times to buy, and we want to be able to have that option on that flexibility. But if it was a lower price environment, what's the strategy? Do we force to sell? Do we, can we ride it out and wait for it to come back? Talk through the strategy there. On
I think if it's a lower price, one of the things I would say is, it presents itself as a great opportunity to buy other projects in the area. One of the things that we have, again, this is in Fund VI, the existing portfolio, we've got a nice line of credit. So we've got access to additional capital.
Yep.
So one of the things is that you would go out and maybe do some follow-on or some bolt-on acquisitions that we thought were really nice, that we would, you could buy the reserves or buy the production for far less than it would take to drill and complete, that same amount of production. So that's one. I don't see a scenario where we would, advocate shutting in. There might be some dog wells that we'd want to shut in, but I don't really see a scenario where we'd advocate that. And then again, in a low price environment, typically your drilling and completion costs are way down as well. So there might be some really nice areas or nice opportunities for us to participate in areas where we actually could get maybe a little bit higher return on our capital deployed because commodity prices are down and we think they might be back up in a year or two.
Right. Yep. No, I love that. Again, I think that's why the strategy is so great when you have the flexibility to do both and buying existing production and participating in new drilling.
Yes.
Because again, there's always going to be opportunity, whether it's a frothier market or a market like now where it's a really good time to be buyer. We can really modulate the strategy based on where the best opportunity is while mitigating the risk through the hedging, through the cash flow, and making those kind of smart decisions along the way to take the best risk adjusted approach.
Yeah, and I agree with you, and I do think one of the things that's bad or would be bad for us, and just something we don't like to do, is have all of our eggs in one basket. Like, we have to drill,
right?
Because we have to have that production or that cash flow.
Yes,
we just don't want to do that.
Yeah, that's not a good place to be in,
no,
right? Where you have to go kind of chase your tail a little bit to hope you can dig out of the hole.
And I think quite frankly, we saw that as an industry in the 2015, 16, 17, 18 period, where we saw a lot of companies that were trying to drill their way out of high debt. And so it just brought on more production, and the more production that it brought on, the lower the prices went. So we've seen it happen.
I'll make this a little comment. This is a little kind of overly simplistic, but it's helpful, I think, when I was kind of getting more familiarized with this industry, right? Coming from more of a real estate background, we love the idea of the cap rate, right? What's the sale price for the cash flow that the asset's generating? And so for, say, commercial real estate, just for simplicity, a nice Class A multifamily building, you might sell at a 5% cap rate. Well, it's probably a little bit higher now, which means it's a little bit lower price you're paying for that cash flow because of interest rates and other things. But maybe it's gone up to 6%, right? So we've had a 100 basis point increase in cap rates.
Yeah.
And that's between, kind of peak of the market, values to a potential trough, and maybe be a little conservative, say it's 150 basis points, even 200 basis points. The thing that's been so unique about this is, and correct me if I'm wrong here, but as I see it, the delta between what a buyer might be willing to pay in a frothy market versus a non-frothy market, the range seems to be really, really wide, and especially the type of sales we're going after where they're not really on market or, lots and lots of buyers competing for it. I mean, we've bought some of our acquisitions at a 20% present value, right? That's effectively a 20% cap rate.
On some of them higher.
Some of them even higher.
Yeah.
Whereas in a frothy market, there were some buyers buying at a 10% net present value, right? And so you think about
or lower. Yes.
Or lower. And
yes.
From just a pure math standpoint, that means the values are actually doubling, or dropping in half based on those cap rates. So it can be such a wide swing of valuations based on what the market's doing, that to me, that's another kind of secret sauce here, and a distinct advantage we have with being able to find the best time to exit these assets is we don't want to bake it in. We don't bake it into the model, the pro forma, but we anticipate we'll be able to achieve some level of alpha, some level of above market returns by buying well when you can get a good deal, and potentially selling at a compressed cap rate, a higher valuation for that same production down the road, though we're not baking that in. Is that, am I thinking about that too simplistically?
No. It is right. I mean, another way I can throw out some metrics. In our existing portfolio, we've acquired producing oil and natural gas on a barrel of oil equivalent below $10,000 per flowing barrel of oil equivalent. So that's in the existing portfolio. Right now, in some areas that we're looking in, we can see that barrels are being traded in the marketplace at $35,000 per barrel of oil equivalent. In a frothy market, and we wouldn't call this a frothy market, in a frothy market, it would be more like $90,000 per a metric per flowing barrel of oil equivalent per day is what the market would pay. So I think, we're again going back to this word opportunistic. We're trying to be opportunistic, but also in our forecasting and in our performance models, I think we've got an exit metric at $35,000 per flowing BOE, and that's kind of what today's market is.
Yeah. Yeah, I think another little side point, and then Ellis is saying we got to get more questions answered here, so shut up, Ben. But I think it's important because these are the things that are so fundamental to the strategy. When we're looking at kind of that exit valuation, it's, again, like you said, we're not baking in a lot of the frothiness of we expect the market to be selling at this much higher price. And well, I lost my train of thought. I was trying to say. Let's go to the questions. They'll come back to me. So Ellis, hit us with some of the rapid fire here. Talk about hold period, equity multiple, anticipated cash flow. Yeah, so it's what we're targeting is kind of a 20 to 25% net return on an IRR basis to our investors, depending on the whole
cycle
period.
Yeah,
full cycle. We're expecting between a 4 to a 7x equity multiple.
Correct.
If we go to the full 10-year hold period, and cash flow, we anticipate a large portion of that return to be from distributions along the way. Now, we don't start with distributions usually for the first year. We usually hold back cash flow to leverage back into more drilling, and then we'll start kind of distributions usually year 2 or so, depending on what the cash flow is, what the opportunities are, and kind of that decision matrix that we use. In Fund VI, the last fund, we accelerated distributions by about a year ahead of time, and we're cash flowing right now between 15 to 17% net cash flow to the investors. So
that's our annualized distribution yield. Yes. Yeah.
Liability to investors. Yes, these are limited liability participations as a passive investor. You would invest as a limited partner, meaning you are not responsible for the liability that you might be the general partner.
And the new fund is Fund VII is an LLC. Again, it's a limited liability company. So their members are really taking on, it's a passive investment. And for all of our funds, if we do take on any debt, it is non-recourse. And it is not recourse to the members in the least bit.
Yes, perfect. Depreciation and depletion allowance flow to investors. No, so that is the trade-off, right? So if if you want, well, I should say it
It
does
does.
not
It does.
flow through to active income.
Correct.
You would
But
get as a general partner.
it does flow to investors. Now, what on the IDCs and all that, you get the depreciation depletion, but if we're doing our job right, we're going to have more than likely higher net income than what our drilling and completion IDCs will be. So
right.
That sometimes is a little bit of people get confused about that. So,
and I think just to be clear, those tax losses flow through to the end investors, but because you're a limited, you're participating in a limited liability company, you can only use those against other passive income, not
correct.
against active income. So that is the difference between losses from maybe other funds that allow you to use it against active. That's not what the strategy is. There's trade-offs there. We've talked about that a lot, so we won't get into it. But talk about some of the deals that you're currently looking at that we're putting LOIs out on and looking for those kind of unique deals that are hiding under rocks here and turn over a lot of rocks.
Yeah, we're pretty excited. I mean, the deal flow is better than I would have expected, quite frankly. We're looking at a lot of deals right now. We haven't really closed the fund. So one of the things that in the next, been a month or two, one of the things that'd be nice, and one of the reasons why we're calling the full amount of capital that people are expected to invest is it will give us a strategic advantage as we are having negotiations with sellers that we'd be able to close quickly. But we're looking at a project in Wyoming right now that I'm very in liking quite a bit. It's got a nice producing property component to it, and it's got some real upside. And it is heavy oil. It does have some natural gas and natural gas liquids as well. So I really like that. We are looking at a kind of a natural gas play in Kansas that we're very familiar with the geology, very familiar with the producing reservoirs. And we think that might be one that we could really buy at a high discount, particularly now with commodity prices down a bit, and we could really lock in some hedges to lock in some long-term hedges to lock in return. And we're looking at some other mid-continent projects that, again, probably have a 60% producing property, 40% development kind of ratio. And so we're kind of spitballing a little bit, trying to see if it's something that we want to, advance. But we're getting ready, and we've got a couple of things I think are getting close. So I'm excited about particularly the Wyoming project.
I love it. Yeah, we talked about that just last week, and a lot of things you're looking at, and we're very, very picky. I think I lost my train of thought earlier. What I was going to say is a lot of the deals that we're going after are, I would say, not entirely insulated from market pricing or whatever, but a lot of times there's external factors that are putting pressure on these sellers to sell that are kind of irrespective of what the current pricing is. And that allows us to go and negotiate really good deals, because in several cases of last acquisitions we've made in the prior fund, these were private equity funds. They kind of were nearing the end of their fund life. They had to sunset the fund and had kind of a defined window to sell, and really wanted certainty of execution. And we were, worked through the relationships that you have in the marketplace. It was more of a negotiated transaction, wasn't put out to tons of bidders. And we're going to get a really, really good deal, right? Because it wasn't necessarily the market that was driving the sale, right? And that's, I think, some of the advantage we have here, again, on the acquisition side. The market will absolutely help, but even still, we're also looking for opportunities that are being created by external factors that allow us to buy we call it distressed because they're not distressed assets, but they're distressed sellers a lot of times. Right?
We don't, when we're talking about, we don't call them distressed, we call them motivated.
Motivated, there you go.
Motivated sellers.
Little nicer.
And you know what, we really resist, we try to stay away from, quote, brokered deals, you know, where there might be 15 or 20 different companies that are competing. That's just not where we're going to do well. There's always someone willing to pay a little bit more. What we really try to do is we try to use our existing relationships that we've developed over the course of the last 30 plus years. And we focus on areas that we like, producing areas that we like, and then see if we can, you know, we've got relationships with folks that own property in those areas. And then, as Ben, as you're saying, try and work out something with those folks. And we think we can get much better deals that way. You know, having having capital available to deploy quickly gives us a strategic advantage to being able to execute that strategy.
Yeah. I think it feels a little counterintuitive. Like, why are we bringing all the capital before we have a deal? But that's part of what drives a lot of these transactions is they need a certain dollar amount by a certain time period, and they want to know you can close, right? It's like the price is almost secondary. It's like we have a need to sell. We have these goals to meet. If you can hit those, we can get to a deal. And that's really where we can go and take advantage of the market. We're about to wrap up here, guys. So I'll also throw one other question or two in, but you know, it's been incredible response already so far. I think we have about $55 million of the $75 million that we're targeting to raise already committed. So a lot of interest, a lot of excitement around kind of the initial kind of push of this fund. And obviously, as we get closer on some of these assets, we put in a lot more information that investors can see and really get their hands on the deal itself. This
Wyoming asset, I mean, it's very, very similar to the pro forma that we put out in the private placement memorandum. And I'm very excited. I think it's an exciting time. And, you know, I got to tell you, I just think we're hitting it right.
Yeah.
It's always best to be a buyer when the perception is that the market's down a little bit.
Totally. Okay. Last question we're going to do here. Most of the oil and gas lease private deals or through the BLM. What does it cost to obtain a lease? I don't know if that's really relevant because we're not really doing leases, but
we do some of it. Obviously, we do some of it. Most of the leases in the Mid-Continent area are, you know, what we call fee leases, or, you know, they're private individuals that own the minerals that we either lease directly or we'll buy the lease from somebody else. This project in Wyoming would have a fair amount of Department of Interior / Bureau of Land Management leases, but you know, we've managed hundreds of thousands of BLM leases in the past, so we really know how to work with the BLM. And for the most part, all of the Bureau of Land Management leases would already have producing wells on them. So it wouldn't be that difficult for us to be able to obtain, the right permitting that we would need to do to be able to either, do some workovers or put some additional midstream or drill wells or whatever it be.
Yeah. Yes. So we're going to be having a recording of this and we'll share this. And for those that couldn't make it live, obviously you can watch this as recorded. Jeff, thanks so much for joining us. Always so helpful, I think, just to get your perspectives on what's happening in the marketplace and, where our strategy is. And again, I think we're pretty excited, and maybe just leave us with a few thoughts, right? What should investors be thinking about? Maybe give some perspective on, this is good time to be getting in.
Well, like I said, I think right now it's really a good time to be looking at making acquisitions. I do think that we are seeing a little bit of negativity on particularly oil prices. As we see rig count go down, I think there'll be the propensity for companies to get a little bit more disciplined. And I think that's going to affect our supply. I think, once the tariffs, kind of get figured out, I think we'll see things going back to, that $65 to $75 bandwidth. And I'm very excited about natural gas. Yeah. There are a lot of good things to be excited about, and I'm excited that we have a pretty large natural gas exposure in our existing portfolio. Yeah. And I think natural gas is a place we should be continuing to look at.
Love it. All right. Thanks, everybody. Hope this was helpful. And thanks for all the questions that you guys submitted earlier. And as always, if you have other questions, reach out to our team, reach out to the fund managers you're working with. They can get those answers for you. And again, really, really appreciate everyone here. Thanks so much.
Thank you, guys. Happy Easter.
Yes. Happy Easter.
Take care.